This is the third in a series of videos designed to educate clients and other financial professionals on the benefits and uses of life insurance. Today we're going to talk about how to use a permanent life insurance policy to increase a client's pension income through his employer. So what does life insurance have to do with an employee pension plan? A lot. Employee pension plans have a built-in insurance cost to them that many people aren't aware of. Depending on the pension option they choose when they retire, this hidden insurance cost can significantly reduce a person's pensionable income during retirement. So how do I know what my pension options are? When you submit your retirement paperwork, your employer's pension provider will send you a statement of pension options. This is the form you complete to access your pension at retirement. Basically, it asks what type of pension you want, and yes, there is more than one choice. Usually there are 4 or 5 options. We are going to focus on the difference between a single life pension and a joint survivor pension. The easiest way to illustrate this is with an example. Bob Smith is 64 and nearing retirement. He and his wife Mary are looking forward to enjoying the golden years, but they want to make sure they maximize their income in retirement. Mary is only 61, but she has suffered some health issues lately. Mr. Smith is in good health, and they also have 3 adult children in their 20s. Mr. Smith is considering one of the following 2 options for his pension. A single life pension, which would end upon Bob's death for $3,500 per month for life, or a 100% joint survivor pension, which pays out until both Bob and Mary have passed away for $2,300 per month. Based on his options, Bob is concerned that they won't have enough income if he elects the joint survivor option. He is tempted to elect to take a single life pension so they have the extra income. However, he also realizes that although he is in excellent health, anything can happen, and if he were to pass away unexpectedly, Mary would be left with nothing. Because of Mary's poor health, she is unlikely to outlive Bob. Bob is in a really tough spot. If he elects to take the joint pension, he and Mary will have a greatly reduced income in retirement. He also knows that if Mary succumbs to her health issues in the next few years, he cannot change his mind and opt out of his joint pension and go back to the higher paying single life pension. However, he also knows that a single life pension is a risky gamble and could leave Mary without a pension on top of her health issues if he were to pass away unexpectedly. Is there a better way? Bob calls his financial advisor to get an opinion. After some discussion with his advisor over his income needs, his advisor recommends they explore a pension maximization strategy using life insurance. Bob has never been a big fan of life insurance or insurance in general, but he is willing to listen. Bob's financial advisor explains to him that the difference in the single life pension of $3,500 per month and the joint pension of $2,300 per month is basically a built-in insurance premium put in place by the pension company. The pension company knows that under a joint pension, they have to pay out a lot longer because the payments must continue until both Bob and Mary have passed away. As a result, the pension they are willing to pay under this option is much lower, $1,200 per month lower to be exact. Bob's joint pension for himself and Mary is also not medically underwritten. That means he doesn't get any credit for the fact that Mary is in poor health. Bob quickly realizes that if he chooses the single life pension, he has an extra $1,200 per month that could be potentially spent on an insurance policy. Bob is hoping to spend about half that, or $600 per month, on insurance, leaving him with an extra $600 from his single life pension that he and Mary can spend on retirement. Bob and his advisor need to answer 2 questions. Number 1, how much insurance can Bob get for $600 per month? And number 2, will that amount of insurance be enough to support Mary if he passes away? Keep in mind, a pension, whether received by Bob or Mary as a survivor, is fully taxable as income, whereas a life insurance payout is received tax-free by the beneficiary. This makes a huge difference when planning for retirement. Bob's advisor provides him with the following insurance quote. A term life policy of $225,000 has a monthly premium of $600. So how long will a $225,000 tax-free life insurance payout last Mary for the remainder of her life? For this, we need to make some assumptions. How long do we expect Mary to live? and at what age do we expect Bob to pass away? Bob's advisor starts with the worst case scenario. Mary lives to age 85. Not that that's a bad thing for Mary. Bob, however, passes away suddenly a month after he retires. In this scenario, Mary would need to stretch the $225,000 over a 24-year period because Bob's single life pension would end at his death. If we assume that she invests the money conservatively and receives a 3% after-tax rate of return, how much could she pay herself after tax every month for 24 years? A simple calculation yields a monthly income of approximately $1,100 after tax. If we compare that to her joint survivor pension, which would yield approximately $1,725 per month after tax, which is derived from the $2,300 she would receive minus 25% average tax rate. In this scenario, Bob would have been better off electing to take the joint survivor pension. Next, Bob's advisor shows a scenario in which Bob lives to age 90 and Mary lives to age 85. In this scenario, Bob and Mary enjoy the benefits of an extra $600 of income every month for their retirement years. As an added bonus, because Bob had an insurance policy, upon his death, the $225,000 of life insurance pays out. Because Mary had already passed away, the insurance would pay out to his 3 adult children. With the joint pension option, the pension ends at the last death and the children would receive nothing. Obviously, with this assumption, using insurance was a far better deal. Bob and his advisor run a series of what-ifs. In the vast majority of these scenarios, using insurance provided far more retirement income than taking a joint survivor pension. Using life insurance instead of a joint life pension does not work in every situation. If, for example, Bob was the one in poor health instead of Mary, an advisor would not likely recommend the strategy. In our example, we have shown how Bob worked with an advisor to explore all his options. An advisor will also consider what other sources of income a retiring person will have. Do they have large amounts of RSPs or other savings? Will the surviving spouse receive a Canada pension, OAS? Does the surviving spouse have a pension from their employer as well? What will the marginal tax rate of the surviving spouse be? A good advisor will work with you to answer a lot of these questions. By the time you have to choose your pension options, you will be in a position to make an informed decision. I would encourage anyone approaching retirement to talk to an advisor beforehand, particularly if they intend to use life insurance to maximize their retirement income. Any insurance policy would have to be put in place prior to making an election on their statement of pension options. I hope this gives everyone a better understanding of the use of life insurance for retirement planning. Thanks for watching.